I'm going to be giving an update on the THORdex, our fixed income indicators, and what parts of the portfolio we are overweighting at this time. Hi, Jim Gore from THOR Wealth Management. Well, it's the beginning of the quarter, and once again, I'm going to give an update on THOR's indicators. The first thing we look at is the equity market, and we're looking at the THORdex, and the THORdex applies to the S&P 500. And you've heard that over the long run, the stock market gives you about a 10% rate of return. That is true. However, the THORdex tells a different story. The THORdex right now is at 78. We're almost pushing 80, which is in the higher end. And if you look at this chart here, and I've circled this, you can see that the average rate of return over the next 10 years is 5.69% for the S&P 500. So what's that telling us is that the risk is higher. And you have to also look at the volatility, to take the volatility in the stock market when you're getting a yield on bonds that is equal or a little bit higher than what you're getting here, the 5.69%. Why put your money into the equity market? The next, and if you look, we get over 80, which we're close to, you're looking at a 10-year annual rate of return of only 2.25%. So this is not a market timing indicator, but it's telling us that the risk is higher in the equities, and that's why we're underweight equities in general, and specifically U.S. large companies. The next thing we look at is fixed income. And we look at two indicators. And we go from a -3, which is not good, to a +3, which is really positive. 0 is a neutral rate. And we look at duration. Basically, how far out in maturities do I want to go? 2 years or 10 years. The more the duration, the further out you want to be in maturity. Next, we look at credit risk. Do I want to buy treasuries that have no credit risk? Or do I want to buy a corporate bond that is high yield, a junk bond, that might go into default? That's the credit risk. And right now, the credit risk is negative. It has been negative for a while. And if you look at this, the duration, getting back to that, the yield on the S&P 500 is about 1.3%. So if I'm looking at income, I wouldn't want to buy the S&P 500. I would rather own bonds that are paying me more than 3 times that yield than it was in the equity market. This is a totally different story than where we were a few years ago, especially during COVID, when you were getting a higher yield in stocks than you were in bonds. The other thing is that you look at credit risk. One of the things we're very concerned about is what is known as private credit. And these are investments in, small businesses. They do not trade, and they're being sold to a lot of people as a safe investment because there's no volatility in price. Well, of course not. These things aren't traded, so they price them at par. And then the other thing is that they're saying, hey, it's good when interest rates go up because it's a variable rate. Well, that's true. But think of it as a small business, and we have some clients that own small businesses with loans, and they're suffering now because those rates have gone from about 4.5% to 8.5%. And if it goes up further from here, what you're going to have is defaults on those bonds. And because they're private, good luck trying to sell those. So that's one of the areas that we're very concerned about the market in general. Also because we have a lot of private credit firms coming to us and trying to meet with us at THOR. And basically 6 months ago, we said, we're not interested in meeting with you at all. Next is looking at what areas of the market we like. Okay, so the equity market is expensive. The fixed income market, for duration is okay, but you don't want to own a lot of credit. So the areas that we like here, and you can see that from a neutral area, and the bars that are above it, we like. The ones that are below it are underweight in our client's portfolio. The only change here from last quarter was the move up in small company stocks. Small company stocks are becoming more and more attractive. However, they're not as attractive as they were back in 2000. And our clients can remember back in March of 2000, we went up to a 40% position in small company value stocks. At the same time, we had 40% in U.S. large company value stocks at a time that no one wanted those positions. But the equity markets as a whole, those individual positions in small company are nowhere near as cheap as where they were in 2000. So that's an opportunity that we see somewhere in the future. We're watching very closely and I can see adding to small companies in our client's portfolio in a meaningful position sometime in the future. But you can see the areas we like are alternatives, like commodities. Commodities are very good in portfolios, and gold miners. Go back and look, and I have a link at the bottom here. You can look at our gold mining update back in September of last year. And gold miners, the gold miner ratio to gold is actually the lowest it's been in the last 40 years. So gold miners at this time is very, very cheap. The other areas that we like is international, especially in emerging markets. And what we like there is emerging markets, small company stocks. You can see the link below. We did an update back in December on emerging markets and why we like them at that time, especially smaller companies, emerging markets. MLPs, energy, we've talked about energy, why we like MLPs, and you just go back to our March 14th update, which is below, why we continue to like MLPs at this time. One area, you can see the areas that are on the bottom here are both large company value and growth, as well as BDCs, which are business development corporations, which actually lend to private businesses. They're publicly traded. At times we like those. That is one of the worst investments at this time that we think you want to be invested in. As always, if you have any questions or concerns, reach out to us at THOR Wealth Management or give us a call. Take care and talk to you in a couple weeks.